Welcome to the deep dive. Today, we are zeroing in on, well, one of the most important parts of filing your taxes every year, claiming your dependents. We've got a great set of sources here, and our mission today is pretty simple. Find the shortest possible list of things you need to get the biggest possible financial return.
That's it, exactly. And our main source for this is coming from a tax preparer, Kalonji Murray, of TaxAssurances.
Yeah.
What we're really trying to do is build that zero fluff checklist, just the absolute essential data points that unlock the benefits you're, frankly, entitled to.
Right. So if you're a parent and you're trying to figure out how to maximize your tax situation, this is for you. We're not talking about a huge stack of forms. We're focused on just three essential pieces of information that make the entire system go. And this can be the difference between leaving money on the table and, getting the best outcome, whether you're married or filing as single.
So let's start with the foundation, the why. It's all about the financial incentive. Murray makes it crystal clear that claiming dependent children is the gate. It's the gateway to really beneficial tax credits and tax deductions. This isn't some kind of loophole. These are defined legal entitlements.
And if you don't provide this basic information, you just lose out on money the government literally says is yours.
You just lose it. Yeah.
And that word entitlement is so key, isn't it? It really changes the whole dynamic. This isn't you asking for a favor. It's about giving the preparer or the software what it needs to claim what you've already earned.
Precisely. The preparer's job is to secure those credits for you, but their hands are tied. They just can't do it without that specific mandated information.
Okay, so let's get down to brass tacks. We know the stakes are high. What's actually on this checklist? What are the three absolute must-haves for the preparer?
The list itself is, it's deceptively simple. But the accuracy is everything. This is all getting cross-referenced with federal systems.
Yeah.
So you need three specific things for every single child you plan to claim. First up, the full names of the children. And it has to be exactly what's on their official records.
No nicknames, got it.
Second, the dates of birth, the DOBs. These two things establish identity and, crucially, age. Age is what determines which credits you even qualify for.
And then there's the third one, the one we really can't stress enough, the Social Security number, the SSN. This might seem obvious, but let's really dig into why the SSN is the absolute linchpin here.
Right, and this is where the technical side really matters.
Yeah.
The SSN is the non-negotiable identifier. The name and the date of birth tell the system who the child is, but the SSN is the unique key the IRS uses to verify that this specific child hasn't already been claimed.
Oh, by someone else, like in a custody situation.
Exactly, or, in cases of fraud. The entire system is built around that number to prevent people from double dipping.
That makes total sense. Without it, the software just hits a wall. It can't connect the person to the federal database, and so it can't validate the claim. It's not just an ID problem anymore. It's a compliance problem.
That's it. You need all three to prove you're both entitled and eligible. So now we can get into how these three pieces, name, DOB, and SSN, actually work in the process. Murray says they're immediately fed into the software.
And here's where it gets really interesting, I think. The mechanism. Once you plug in those three inputs, the software it takes over. It uses them for every single calculation from that point on. And it's designed to, as he says, trigger that information. Basically, it flags your file for all the benefits that might apply. But before we get to those specific benefits, we have to talk about something people often mix up. The difference between a credit and a deduction.
Yes, this is probably one of the most valuable things to understand for general tax literacy. Credits are almost always more powerful.
Okay, break it down for us.
A tax deduction reduces your taxable income. So let's say you're in the 20% tax bracket. A $1,000 deduction saves you $200 in actual taxes. It just shrinks the amount of your income that gets taxed in the first place.
Right. It lowers the mountain before they calculate how much of the mountain you owe.
That's a great way to put it. Now, a tax credit. That's a dollar-for-dollar reduction of the tax you actually owe. A $1,000 credit means you pay $1,000 less in tax. Full stop.
Whoa.
That's a huge difference. And some credits can even be refundable, which means if the credit takes your tax bill down to zero, you can actually get the rest of the credit back from the government as a refund check.
Okay, that is the big aha moment. So we're talking about inputting three simple things to unlock these credits, these direct cash reductions, which are way more powerful.
That's the name of the game.
So now we know how powerful credits are. Let's look at the triple play of benefits that these three little pieces of data unlock. Name, DOB, and SSN. What are the big ticket items the software starts calculating?
Main one, the one everyone's heard of, is the child tax credit, the CTC. Our source names it explicitly. It's the
Whoa.
absolute cornerstone for families, and it's calculated based on how many kids you have and how old they are, which is why the DOBs are so important.
And like we just said, since parts of the CTC can be refundable, getting this right could literally mean thousands of dollars back in your pocket. What's the second big one?
The second one is the dependent care credit, or DCC. This one applies if you're paying for childcare like daycare or after-school care specifically so that you can work or even look for a job.
That's massive for working parents. I mean, childcare costs are substantial, so the data triggers your eligibility, and then you just have to have the receipts to back it up.
Absolutely. So that's two incredibly valuable credits right there. And the third benefit is a higher standard deduction. Now, this one isn't a credit, but having dependents can change your filing status and raise the amount of your standard deduction, giving you another automatic boost.
Wow. So that is a really potent mix. You've got the huge child tax credit, the work-related dependent care credit, and a bigger standard deduction, all triggered just because you provided a name, a date of birth, and a social security number.
That's the whole point. The preparer's goal is to maximize your return, and this is how the system's designed to do it. It all starts with those three inputs.
So to kind of wrap this all up, the big lesson here is about efficiency. Just accurately gathering and providing three basic pieces of information is the key that unlocks all these complex, high-value benefits. The CTC, the DCC, a higher standard deduction.
It's the 80-20 rule of tax prep, really. A
Yeah.
tiny input creates a massive output.
So what does this all mean for you, for the learner? This isn't just a reminder to be organized. It's a structural insight. Your first step for tax season shouldn't be hunting for crazy forms. It should just be confirming you have those three correct data points for every single one of your dependents. That's the starting block.
And, it makes you wonder, it raises a bigger question that goes way beyond taxes. If these three simple pieces of data are so vital to this huge financial outcome, what other basic, seemingly simple inputs might be missing in other parts of your financial life, like in your retirement planning or your investments? Where else can a small, correct input trigger a massive result?
That is a really compelling thought. Auditing your most basic inputs to see if they're actually set to unlock your maximum potential. Well, thank you for joining us on this deep dive. We hope this breakdown helps you file with more confidence and get every single dollar you're owed. We'll see you next time.